Today, we're going to dive into a really fascinating paper from the National Bureau of Economic Research. It tackles a massive question. How on earth do you steer an entire economy when the things you do today won't actually have an effect until way in the future? Well, it's a challenge that Nicoletta Batini and Andrew Haldane took on, and believe me, their answer is a game changer.
So, let's start with a simple question, one that has a surprisingly tricky answer. How do you stop a supertanker? I mean, really think about it. You've got this vessel, hundreds of thousands of tons, just plowing through the ocean. You can't just hit the brakes when you see the dock, right?
Well, the answer is you have to cut the engines miles, and I mean literally miles, before you even get close to where you want to stop. There's this massive delay, a huge lag, between taking the action and getting the result. And that, right there, is the perfect metaphor for one of the biggest challenges in all of economics.
And this brings us right to the heart of the central banker's dilemma. You know, their job is to steer the economy, right? Keep inflation nice and stable, keep people employed. But just like that supertanker captain, they are dealing with these enormous lags. The decisions they're making right now won't be fully felt for a very long time.
What's really wild is that this is not a new problem. Not at all. All the way back in 1923, the legendary economist John Maynard Keynes absolutely nailed it. He warned that if you wait until you can see the problem, like prices starting to creep up, you're already too late to do anything truly effective about it.
So think about it. When a central bank raises or lowers interest rates, that's just the first domino tipping over. It takes a long time for that change to ripple through the whole system, affecting borrowing costs, how much people spend, how much companies invest. Economists have a name for this. They call it the monetary transmission mechanism, and it has long and variable lags. That means the full punch of a rate change on inflation might not even land for a year and a half, maybe even 2 years.
Fast forward a few decades, and you've got former Fed Chair Alan Greenspan framing the exact same challenge. He said the real job isn't to react to today's numbers. It's to anticipate what the economy is going to look like a year or two from now and take action before it happens. You have to steer for where the economy will be, not where it is right now. But how in the world do you do that?
Well, this leads us to this really powerful analogy for the old way of thinking about this problem. It's like trying to drive a car forward, but you're only allowed to look in the rearview mirror. You're constantly reacting to where you've just been, not where you're actually going. And on a winding economic road, that is an absolute recipe for disaster.
So this sets up two completely different ways to think about policy. On one hand, you have the backward-looking approach. Think of the famous Taylor rule. It basically tells central banks to set interest rates based on what inflation and the economy were doing in the recent past. But the forward-looking approach? Totally different. It's all about setting interest rates based on a forecast of where you think inflation is headed.
Of course, this whole idea of acting on forecasts, it had its critics. The great Milton Friedman was famously skeptical. He basically compared economic forecasting to weather forecasting and said, good luck with that. For a long time, this was the main view, that forecasting was just too unreliable to bet the entire economy on.
But this is where Batini and Haldane's paper really shines. They decided to take this idea of a forward-looking rule and put it to the test. And I mean a serious test. They came up with this simple, really elegant rule based entirely on forecasts, designed to solve that supertanker problem once and for all.
So their core idea is what they call the Inflation Forecast-Based Rule, or IFB rule for short. It's a simple idea, but it's incredibly powerful. Just tie today's policy decisions to a forecast of tomorrow's inflation. This is a fundamental shift, moving away from reacting to the past and towards acting on an educated guess about the future.
And the authors break their rule down into 3 simple dials that a central banker can basically tune. So first up is the forecast horizon. How far ahead are you looking? 1 year? 2 years? Second is aggressiveness. How hard do you react to your forecast? Are you going to just gently tap the brakes, or are you going to slam on them? And third is smoothing. Do you make big, jerky changes to interest rates, or do you prefer to make small, gradual adjustments over time? So what did they do? They built an economic model and ran thousands of simulations. And what they discovered was that this forward-looking approach has what they call an encompassing advantage. It's not just a little bit better, it's fundamentally superior in a few really important ways.
These advantages fall into 3 buckets. They call them encompassing properties. The first is that the rule encompasses the economy's natural lags. The second is that it encompasses all the available information out there. And the third one, which is kind of surprising, is that it even encompasses the goal of overall economic stability.
So let's break down what each of those actually means.
Okay, let's start with lag encompassing. This is the big one. This is the solution to our super tanker problem. By setting your forecast horizon, that's dial number 1, to match the time it takes for your policy to actually work, you perfectly align your actions with their effect. You're essentially cutting the engines at just the right distance from the dock. It's brilliant.
The second advantage is information encompassing. See, a good inflation forecast isn't just some number plucked out of thin air. It's a summary of everything that's going on in the economy, from what's happening with asset prices to wage growth to global supply chains. So by relying on a forecast, you're naturally using a much richer, much more complete signal to guide your decisions.
Now, this third one, output encompassing, is a bit of a head-scratcher at first. You'd think a rule that only cares about inflation would cause wild swings in economic growth, right? But what the authors found was that if you set that forecast horizon just right, the rule automatically helps stabilize the whole economy. It prevents those big booms and busts, all without ever directly targeting economic output. Pretty cool.
So, at the end of the day, what's the goal for any central bank? It's to find that sweet spot. You want a policy that keeps inflation from jumping all over the place, but you also want to do that without causing huge swings in economic growth and unemployment. The authors use their model to hunt for the one rule that could do both of those things best. And the results are just, wow, they're striking. A myopic rule, one that only looks at what inflation is doing right now, that's the bar on the far left, it leads to massive volatility in the economy. But look what happens as you start looking ahead. A horizon of 3 to 6 quarters out dramatically crushes that volatility without letting inflation get out of control. That right there, that is the sweet spot. This is the proof in the pudding that looking ahead is just a much, much better way to steer the economy.
So just how much better is it? Well, the authors calculated something called welfare loss, which is basically a measure of the economic pain caused by all that instability. And they found that even the best possible backward-looking rule was nearly 50% worse than the optimal forward-looking rule. That is a huge, huge improvement in economic stability.
Okay, so let's pull this back from the world of economic models and into the real world. Why does a paper from 1999 still matter so much today? Well, because it provides the intellectual firepower, the theoretical backbone for how pretty much all modern central banks operate. It's all about trying to forecast our economic weather.
Ultimately, what this paper does is give a powerful justification for the way modern central banks do their jobs. It proves, using models and data, that acting preemptively is way better than reacting after the fact. And honestly, it explains why central bankers are always talking about the future. The next time you hear one on the news, you'll know they're not focused on last month's data. They're trying to look 1 or 2 years down the road, steering that supertanker to a safe harbor.
And that leaves us with one final, pretty provocative question that the authors themselves bring up. If targeting a future forecast is so effective, should we maybe take it one step further? Instead of just aiming for, say, a 2% inflation rate next year, should central banks actually promise that the overall level of prices will be at a specific point in the future? It's a subtle but really profound difference, and it might just be the next big evolution in this incredible challenge of steering the economy.